Hi everyone, I'm Siddhant. Today we are taking the chapter number 9, GDP concept, in which we will understand first the some basic things about GDP, then we will move into the questions. Now, in India or any other country, the GDP can be calculated through three methods. The first one is the production method, second income method, and third is the expenditure method. And the definition of the GDP stands that the production of the goods and the services inside India or the Indian territory is the GDP. So this definition comes from the production method of the GDP. As we have read in GDP, there are three methods: production method, income method, and expenditure method. And this definition comes from the production method. And the one of the most important component of the method to calculate the GDP is the expenditure method, which our government also uses. Central Statistics Office uses that expenditure method to calculate the GDP. And we will now see the formula of that GDP of the expenditure through the expenditure method. The formula of the GDP calculation. The formula is CIGNX. So here the C stands for consumption. Consumption by common people. The second component is the investment. Investment by any companies or entity. Third one is the government expenditure or consumption. And fourth one is the import minus export. So this is the formula to calculate GDP through the expenditure method. And now we will see some questions. The first question is, gross national income at market price is calculated as. Okay, as we have read the GDP, and through that GDP the gross national incomes at market price is calculated. Okay, first we will see that GDP is of two types. That GDP at not two types actually, but it is most common two types: the GDP at factor cost and GDP at market price. So what's the difference between the GDP and the factor cost? We will understand with an example. For example, you are having a manufacturing company of bread. Now you are producing bread, and when you are producing bread, you have some input cost or the raw material cost and all the cost that you incurred while making the bread. So that cost is the factor cost. So if we calculate GDP at that cost only, that is the GDP at factor cost. But when this bread going to sell in the shop, what government do? The government add taxes in it and subtract subsidies. So what is the cost become, and what is the cost become after adding taxes and the subsidy? Subtracting subsidy is the GDP at market price. So this is the difference between the factor cost and the market price. Now the gross national income at market price is calculated as, it is the option B, GDP at market price plus taxes minus subsidy plus compensation to employees plus property income. You need to remember this formula. You don't need to research in this formula, because there is nothing much in the syllabus. It's just the formula needed to remember. That's it. Next question: investment component in the expenditure method of the GDP has. As we have read in this formula, this is an expenditure method. There is a component called investment. So what this investment means, we will see the option A, the capital investment in physical assets such as infrastructure, building, equipment, machinery, etc. So first we will understand what is capital investment. Whenever you do expenditure for creating an asset for the long term uses, we will take an example of the capital expenditures or the current expenditure. If you buy a car, then it's a capital expenditure. Why? Because you are creating an asset of that car, and it has a long term uses. But when you buy petrol for that car, that is a current expenditure, because it vanishes after a very short term uses. So that is the difference between the capital and the current. Now option A is the capital investment in the physical assets, the infrastructure, building, equipment and machinery. Yes, investment component in expenditure method of GDP has this capital investment into picture. Second option, investment in the financial products. No, it is not added. Option B is not added in the investment component of the expenditure method, because the investment in the stocks and the mutual fund is volatile in nature. So it is not added. So option is A. Next question, GDP at factor cost is equal to, we have understood with an example the factor cost and the market cost. And so the formula is GDP at factor cost is equal to, we have seen here that GDP at market price. If we add taxes minus subsidy at factor cost, then we get the GDP at market price. So when we need to find the GDP at factor cost, then we need to, if we substitute that taxes here, it will become minus, and subsidies, if we go this side, it will become plus. So this is the formula, and the option is A. I hope you are understanding. Next question, GDP calculated on the basis of some base year price, it is called. Okay, we will understand what is base price, what is current price as far as the GDP is concerned. GDP at base price means the government takes some year as a base year, and whatever the price in that year, the government will take that price only, and it is used, this price is also used in to calculate the GDP at 12, 2013, 2014, and when and till whenever and whatever time the government wants, this the base price will be used for all. This is why the government is doing like this, because the concept of base price came. Reason being, for example, in 2011 the government, you are producing bread, and that bread cost is 100 rupees, and you are producing 10 number of breads, so the GDP in 2011 is 1000. Now in 2020 you are producing the same number quantity of bread, but due to the inflation, the price increase, the price of the one bread becomes 150. So now the GDP becomes 1500. So you can say that the GDP got increased, but actually it is not increased because the quantity remained the same. So in order to have a equal ground for calculation of the GDP of every year, they fix the base price of 1 year. They take the base price of 1 year and calculate GDP of all the years. So here the option is B, GDP at constant prices. And what is GDP at the rate current prices? The GDP at current prices means whatever the prices of that particular year, the government will take that price and find the GDP. This will not give the real picture, but at the constant price it will give the real picture of the country. What GDP does not tell? Aggregate measures. Yes, it tells aggregate measures because GDP is the calculation of the of all the goods and the services produced inside the territory, is the aggregate only. So A, GDP tells about the aggregate measures. Option B, GDP distribution among citizen. Yes, GDP does not tell the distribution among citizen, because if in India the GDP is around 3 trillion $3 trillion, it does not tell that 3 trillion is distributed among all the 130 crore of people. Might be what it is true that money has more amount of money than us. So GDP distribution among citizen, GDP does not tell, because it is random. Someone has lot of money, someone has very less money. See, higher GDP does not mean all around prosperity. True, this statement is true. D, per capita income does not provide information on the distribution. Yes, D is also. What is per capita income? The total GDP divided by the total population of the country is the per capita income. It does not provide information on the distribution. Yes, this does not provide the information on the distribution, because for example, if the GDP is 100 and there are 10 people, then it is the per capita income saying that the 10 rupees is with the all the 10 people has 10 rupees. But actually if we go inside, we see that one person has 90 and another person has 1 and 2 rupees in hand. So that is the problem with the GDP. Next question, GDP plus dash provides real picture of the country. GDP does not tell anything about the real picture of the country. Whenever GDP combines with the Human Development Index, then only it gives the real picture of the country. Because Human Development Index takes concern of the education, literacy, knowledge, and health, everything into concern, and shows the real picture of the country. Next question, GDP does not reflect the total income of the country if the country is export oriented, because the GDP formula itself is a stands that it's a calculation of the goods and the produced in the country, so it does not take export into concern. Next question, which one is better? Whether the option is GDP at market price, GDP at factor cost, and the option D is gross national product. Okay, we will see. First, we know that GDP at market price and GDP at FC, and GDP here itself very not very specific, so we cannot comment upon. But as far as this question is concerned, GNP is the answer. Now we will see what is GNP, gross national product. So whenever in GDP, if we add, okay, we will take new page. Let's say in GDP we will add something, we get gross national product. To convert gross domestic product into gross national product, we are adding something which is NFIA, net factor income from abroad. What is this? For example, if Shah Rukh Khan works in some Hollywood movie, so he gained some amount, and for example Brad Pitt works in India, he gets some amount. So it's a difference. This NFIA is the difference. The citizen of our country earns outside our country, other citizens earning inside our country. So NFIA is the difference between them. So GNP gives the real picture because it takes into concern of all the citizens earning inside India. Next question, which of the following is the term associated with the GDP? Option is A, green GDP, orange GDP, yellow GDP, white GDP. The option is green GDP. If GDP of any country takes concern of the environment as well, then it's a green GDP. New way to calculate GDP through GVA is, first we will see GVA. Previously, as we know that GDP at market price is equal to GDP at factor cost plus taxes minus subsidy. So previously, any government is taking GDP at market price into concern to calculate the GDP, but the government later find that it is not giving the real picture. Why is it so? Because any country, if they increase the taxes, it will increase the overall GDP of the country. So the government thought that in order to find the real true picture of the country, we need to take GVA at base price. So what is this GVA at base price is equal to GDP plus product taxes minus product subsidies. So here the GVA can be found as all the products that is produced in the company or the industry, we will take plus whatever the taxes the company or the factory is paying in order to produce in the process of production. What is that product taxes? Example, like we are doing contracts, etc. So these taxes, while the taxes applied while doing the production, that taxes is taken into concern, not the taxes what government applies after the products are made. So this is the difference between the GDP at market price and GVA basic price. This GVA at basic price gives the real picture. So the new way to calculate GDP through GVA is equal to GVA at base price plus product tax minus product subsidies. This is the formula. So that's it. Thank you. Please subscribe the channel.